The UK has now entered a new era of trade and relations with the EU following the end of the Brexit transition period at the start of the year. Having left the trading bloc with a new free trade deal, it was hoped that businesses would face minimal disruption and avoid tariffs altogether in many cases. However, as time goes by, it's clear that many businesses are still uncertain about the new rules and regulations under the EU-UK free trade deal and the prior withdrawal agreement, which sets out how trade, travel and work will be conducted in the future. With so much confusion and complexity over the more than 1,000 pages of the post-Brexit trade agreement, this presentation seeks to settle some of the immediate issues that many businesses are facing. Since the 1st of January 2021, the process for importing and exporting goods has changed, and businesses must now make export and UK exit safety and security declarations for all goods leaving the UK and entering the EU. Businesses that import and export must undertake certain steps under these new customs arrangements. To help businesses adapt, HMRC will introduce the new border and customs controls via a new core model, which will be delivered in 3 stages up until the 1st of July 21 to help businesses with the requirements of importing goods to the UK. In the first stage, from the 1st of January this year, customs declarations will be needed for controlled goods and excise goods such as alcohol and tobacco products. There will also be physical checks at the point of destination or other approved premises on all high-risk live animals and plants, and a requirement to pre-notify for certain movements of goods. Importantly, though, goods will not be required to enter Great Britain and be checked at a border control post. The second stage, which takes place from the 1st of April 2021, will require pre-notification and the relevant health documentation on all products of animal origin, for example, meat, honey, milk or egg products, and all regulated plants and plant products. At this stage, all physical checks will continue to be conducted at the point of destination. The third and final stage takes place from the 1st of July 2021, when there will be full controls in place for all goods that are imported. Goods businesses will have to make full customs declarations at the point of importation. Full safety and security declarations will also be required, while for commodities subject to sanitary and photosanitary controls, these will have to be presented to border control posts, and there will be an increase in physical checks at the UK border as well. Although this staged approach ensures that businesses importing non-controlled goods can opt to delay customs declarations for up to 6 months, they must make sure they keep sufficient records of imported goods in this period. There is no mutual recognition of conformity assessment in the agreement, which means checks on product standards is going to be more difficult. If you want to sell your product in both the UK and the EU, you may have to get it checked twice to get it certified. On other border issues, there is also no agreement on recognising safety standards for exporting food of animal origin, which means potentially costly checks for products going into the EU single market. There will, however, be some measures which cut technical trade barriers, and the mutual recognition of trusted trader schemes stay in place, which will make it easier for large companies to operate across borders. At this stage, though, it is important that businesses acquire a GB EORI number or EORI number if you intend to import or export from the EU. If your business makes declarations or gets customs decisions in an EU country, you'll need to get an EU EORI from the customs authority in the EU country where you submit your first declaration as well. It's also important to prepare to pay or account for VAT on imported goods, consider commercial arrangements and terms of trade, determine the customs value of goods, confirm rules of origin, and consider how customs declarations to HMRC systems will be made and the use of a customs intermediary. Businesses in certain industries may also need to check what export licenses or certificates they require, the marking, labelling and marketing standards for food, plant seeds and manufactured goods, and the rules for exporting or importing alcohol, tobacco and certain oils. If you move goods into Northern Ireland or via Northern Ireland into the EU, then you can sign up for the government's free trader support service. And in this instance, you should acquire an XI EORI number. This free-to-use trader support service is available to businesses of any size, moving goods into Northern Ireland, providing guidance, training, a digital declaration support service, and support from customs experts. Tariff-free trade with the EU is based around the concept of the rules of origin. Under the EU-UK Free Trade Agreement, tariffs will not be charged where a business can demonstrate that goods meet these rules and are predominantly of UK origin. The simplest way to think about the rules of origin is to give goods being imported and exported an economic nationality. This determines where they have been produced or manufactured, not just where they have been shipped or bought from. There are two different types of rules of origin, preferential and non-preferential. Under the Free Trade Agreement, the former applies, meaning that the UK and the EU have agreed to remove tariffs for each other's goods. This grants a preference not provided to other nations with such a deal. UK goods seeking to enter the EU under this preference have to prove that they are from the UK under particular rules agreed in the Free Trade Agreement. This prevents a country without a trade deal from accessing the EU market through the UK and vice versa. Generally speaking, the Free Trade Agreement says that goods must be locally sourced or must have had sufficient work carried out on them in the UK. However, already we have seen some conflict with items such as Marks and Spencer's famous Percy pig sweets, which have seen tariffs placed upon them because despite being packaged and developed in the UK, the products themselves are produced in Germany. This matter is in fact far more complicated than this. How it applies to each sector or to each individual item exported and imported between the EU and the UK varies. And this only becomes more complicated when you consider more complicated manufactured items. The complexity of supply chains can mean that proof of origin can be difficult for traders to supply and equally hard for authorities to assess. The first step for a business is to determine what good is being traded. The World Customs Organization has a list classifying every product traded under tariff headings. Each product has a unique code, which is grouped into broader categories. Once the good is classified, the next step is to establish its economic nationality, as opposed to simply the country it came from. This involves determining the good's value and where the contributions were made in adding value to the final product. If all materials were obtained and processed in one state, it would be wholly obtained in that country. That would apply, for example, to agricultural produce, raw materials, and natural resources. But consider for a moment a car. It may be made up of thousands of individual components down to individual bolts and bulbs, each of which comes from a different supplier around the world. With multiple components adding value, it can be very difficult to determine origin for some products. In this case, the final product is determined by the location of the last substantial transformation. For preferential origins, such as the EU-UK relies on, substantial transformation is defined through one or a combination of three main criteria. these being change of tariff classification. So this is when the work is undertaken within a country resulting in a change of classification. For example, the unique code for car parts 8708 is different to the code for a finished car 8703. If a country assembles car parts into a finished car, it would qualify as a change of tariff classification. Then there's sufficient value added. So the originating state must contribute a minimum percentage of the value of a product. Each component will add a certain amount of value, calculated as the percentage of the X works price of the final good, i.e. the total price of the inputs to the good, exempting transportation and insurance cost. And specific processing. So finished products can qualify when particular specific working or processing activities are carried out. For example, a rule may require clothing products to be manufactured from yarn. The precise rules are very detailed and can change for each product depending on what is agreed in the free trade agreement. Typically, for preferential origin, such as is found in the new free trade agreement, more than 50% of the value has to be added to the claim origin, but it differs for each classification of goods. From 1st of January 2021, in order for businesses to benefit from preferential tariffs when importing into the UK or EU, they must claim preference on their customs declaration and declare they hold proof that the goods meet the rules of origin. This can take the form of a statement of origin completed by the exporter on a commercial document, or knowledge obtained and held by the importer that the goods are originating in the UK. The UK and the EU have agreed to a 12-month grace period. This means that until the 31st of December 2021, businesses do not need suppliers' declarations from business suppliers in place when the goods are exported. But they must be confident that the goods do meet the preferential rules of origin. Businesses may be asked to retrospectively provide a supplier's declaration after this date. The UK has been reliant on the EU for free trade agreements, and its departure from the Union means it can no longer rely on existing deals it had in place. Thankfully, the UK government has managed to complete a number of continuity deals that maintain similar arrangements with many non-EU countries, including Canada, Mexico, and Switzerland. It has also begun to complete entirely new free trade agreements with other nations, including Japan, and is exploring other deals with new nations such as Australia and the USA, which the EU currently has no free trade agreements with. In the coming years, the UK should begin to see a number of new tariff-free trade arrangements with a growing assortment of countries, which should reduce the cost of importing and exporting overseas and opening new markets to UK businesses. Goods that move into the UK from the EU from the 1st of January 2021 onwards will be considered imports, meaning import VAT will be payable and customs declarations will need to be made. Businesses must account for VAT on all goods imported using a postponed accounting system. This means that import VAT on goods is accounted for and paid via a company's usual VAT return rather than paying it immediately at the point of entry. In reality, this means that rather than physically paying import VAT and then reclaiming it on a subsequent VAT return, VAT is accounted for as input and output VAT on the same return. Postponed VAT accounting therefore presents an immediate impact to a business's cash flow when importing. In fact, if a business already imports from outside the EU, then it might see cash flow benefits from the new system because it removes the need to account for the import VAT typically due. This applies to all goods imported by VAT-registered importers to the UK from anywhere in the world if they're worth more than £135, including those from the EU. In most cases, import VAT should be recoverable by businesses. Businesses have to account for import VAT via their VAT return under the postponed accounting system if the goods they are importing are for use in their business. A business must include its EORI number, starting with GB on its customs declaration, and its VAT registration number if it's needed. If you haven't yet applied for a GB EORI number, then it doesn't take long and it's an essential part of importing and exporting goods. You may also need an EU or XI EORI number, as we've outlined previously. Once you have that number, you can then account for import VAT on a VAT return when you submit a declaration that releases goods into free circulation from one of the following special customs procedures. And those are customs warehousing, inward processing, temporary admission, end use, outward processing, duty suspension. You can only account for import VAT on a VAT return once excise goods are released for use in the UK, also known as released for home consumption. If the business imports goods that are not controlled into Great Britain from the EU, between the 1st of January and the 30th of June this year, they must also account for import VAT on their VAT return. Controlled goods are goods that have or must have a licence to import or excise goods like alcohol or tobacco, which have additional duties on them. This rule still applies even if you delay the customs declaration. For example, if you decide to record the information for your own purpose now and tell HMRC up to 6 months later. Businesses that import goods regularly can set up a duty deferment account that allows them to delay paying most customs charges, including import VAT. Through this account, a business can make a single payment each month via direct debit instead of paying for each consignment separately, as would be expected under the usual system of postponed accounting of import VAT. Under this system, you can pay the duties and import VAT you defer during one calendar month as a total sum, either on the 15th of the next month or on the next working day after it if the 15th is not a working day. This means that you can defer duties and import VAT for between 2 and 6 weeks, offering an average of 30 days credit. The scheme is open to importers or customs agents and freight handlers that work for importers and have an approved deferment guarantee or waiver in place. Regardless of the method of accounting for VAT on imported goods, checks to ensure that the data on the customs declaration is accurate and will continue to be highly important for VAT purposes for all imports. With postponed accounting, the only differentiator from the previous system is that you will record and pay for VAT on a return rather than at the border, which helps with cash flow. To do this, but you must do this for each consignment that comes in. This system is automatic for all import VAT now. With duty deferment, all consignments are combined into a single payment via direct debit, and it allows import VAT to be deferred for potentially longer than postponed accounting. This system is really intended for those exporting regularly and handling a large number of consignments. Primarily, this will be for customs agents or larger businesses, and you must apply for an account before you can use it. Businesses must determine the country where a supply takes place for VAT purposes so that they know where the VAT due is payable. Businesses should be aware that they may continue to create VAT liabilities in other EU member states. This may mean that businesses in the UK require multiple EU VAT registrations within each member state they trade in. Similarly, if you're an EU business selling to British customers, you need to register for UK VAT as of the 1st of January. You're not allowed to sell products to UK consumers if you're not registered for UK VAT. The one exception to UK VAT registration requirements is for business-to-business remote sellers. Remote sellers don't need to register for UK VAT if they sell digital products only to businesses and/or professionals. So this has to be 100% B2B. If you think you or part of your business falls into this category, we recommend you confirm your particular case with HMRC or a professional tax advisor. Businesses need to be aware that the rules for VAT registration differ from one member state to the next, and so it's vitally important that they research this and complete the necessary registrations. Details of the various EU VAT rules can be found on the European Commission website. When it comes to VAT compliance in EU member states, businesses may need to appoint a fiscal representative. They are a special type of VAT agent for foreign businesses with a VAT registration in another country. They are responsible for the correct calculation and reporting of VAT of their client and are the first point of call for the local tax office in the case of questions or audits. They are usually held jointly and severally liable for any unpaid or undeclared VAT of their non-resident clients. They therefore typically charge higher fees and often require a bank guarantee or cash deposit to protect them against any client losses. Businesses dealing with business-to-business sales are likely to also want to confirm the VAT details of customers. The EU VAT registration number validation service allows businesses to check if a customer or supplier's VAT number is valid. UK businesses will be able to continue to use the EU VAT number validation service to check the validity of EU businesses, but UK VAT registrations will cease to be included. HMRC has developed a service to ensure that UK VAT numbers can continue to be validated. Imported goods in a consignment not exceeding a value of £135 or €150, excluding specific excise goods and gifts, will not be subject to import VAT at the border and will be subject to sales supply VAT instead. This will end the £15 or €22 VAT exemption thresholds previously known as low-value consignment relief, and VAT will now be charged on the goods if they were supplied in the UK and accounted to HMRC on the UK VAT return. This means that businesses selling goods to be imported into the UK with a value not exceeding £135 or €150 will be required to charge and collect any VAT due at the time of sale. For UK VAT registered businesses importing goods in a consignment not exceeding £135 or €150 in value that has not been charged VAT at the time of purchase, they can account for this VAT on their VAT return under the usual reverse charge method. Online marketplaces, where they are involved in facilitating the sale, will be responsible for collecting and accounting for the VAT. For goods sent from overseas and sold directly to UK customers without online marketplace involvement, the overseas seller will be required to register and account for the VAT to HMRC. Business-to-business sales not exceeding £135 in value will also be subject to the new rules. However, where the business customer is VAT registered in the UK and provides its valid registration number to the seller, the VAT will be accounted for by the customer by means of a reverse charge. Also, with effect from the 1st of January, the distance selling rules are no longer applicable as the UK is no longer part of the EU. There is no VAT registration threshold for businesses established outside the UK, so businesses will be required to register for VAT on any value of sales where you become liable for VAT under these new measures. Currently, UK firms incurring VAT in EU countries can claim the VAT back subject to national rules via HMRC's dedicated refund portal for supplies made prior to the transition period. That arrangement will remain in place until the 31st of March 2021, after which time there is currently no specific provision in place to claim for VAT incurred in 2020 under the terms of the withdrawal agreement. VAT incurred after the 31st of December 2020 will have to be made manually to the individual tax authorities concerned. Post-Brexit, there should be minimal impact on the supply of services. Business-to-business services are treated as though they are supplied where the customer belongs, and that customer must account for the local VAT. This will mean that for UK service suppliers, they will continue to not charge UK VAT. For business-to-consumer supplies, UK VAT generally applies, and this will also remain the same. When receiving services, UK businesses may still have to apply a reverse charge to the receipt of services from non-UK suppliers. This ensures that there is no competitive advantage from sourcing services via non-UK suppliers. After the 31st of December 2020, all supplies of digital services to consumers in EU member states are liable for VAT in the consumer's member state. The £8,818 annual threshold for cross-border sales of digital services to EU consumers no longer applies. Organisations will have to charge VAT at the rate where the customer is based and declare those sales to the relevant EU member states. UK businesses that had been using the UK VAT MOS Union scheme can continue to use the system, but must register for the VAT MOS non-union scheme in EU member state. For businesses wanting to continue using MOS, they must register for the scheme by the 10th day of the month following their first sale after the UK leaves the EU. For example, registered by the 10th of February 2021 if a sale is made in January 2021. UK businesses will only be able to register after the 31st of December 2020. Alternatively, organisations can register in each EU member state where they make sales. Check the EU's Europa website for further information about registering for VAT in EU member states. Non-UK businesses that had previously used UK VAT MOS non-union scheme will now need to register for the scheme in an EU member state. Non-UK businesses need to declare sales of digital services to UK consumers by registering for VAT in the UK and declaring the sales via a UK VAT return. As of the 1st of January 21, businesses are no longer able to use the UK's MOS scheme to report and pay VAT on sales of digital services to consumers in the EU. Businesses that sell digital services to consumers in the EU have to register for the MOS non-union scheme in one of the remaining 27 EU member states. The Institute of Chartered Accountants in England and Wales understands many businesses are considering doing so in Ireland. Under the non-union MOS scheme, businesses wishing to use the scheme must register by the 10th day of the month following a sale. Both the EU and the UK want data to flow across borders as smoothly as possible, but the agreement also stresses that individuals have a right to the protection of personal data and privacy, and, to quote a line in the agreement, that high standards in this regard contribute to trust in the digital economy and to the development of trade. The EU has agreed to a period of 4 months, extendable by a further 2 months, in which data can be exchanged in the same way it is now, as long as the UK makes no changes to its rules on data protection. After this period ends, the data rules are likely to remain relatively unchanged, as UK businesses will need to comply with the UK data protection law, which is enshrined in the Data Protection Act of 2018. Looking ahead, Businesses will also need to comply with any changes to EU GDPR if they offer goods or services to monitor the behaviour of individuals in the EEA or have branches or offices in the EEA. Businesses should still consider their current compliance documentation and whether it needs to be updated or revised to deal with changes resulting from Brexit, including a review of data protection impact assessments, records of processing activities, privacy policies, and agreements relating to the transfer of personal data. The end of the transition period also signifies the end of the free movement agreement between the EU and the UK. This means that steps need to be taken to retain existing talent or recruit new talent where the employee is an EU citizen. Employers should check whether existing employees from EU member states need to apply to the settlement scheme. A person is eligible for settled status if they started living in the UK by the 31st of December 2020 and have lived in the UK for a continuous 5-year period. 5 years continuous residence means that for 5 years in a row, they have been in the UK, the Channel Islands, or the Isle of Man for at least 6 months in any 12-month period. If they do not have 5 years continuous residence when they apply, they usually get pre-settled status. To get this, they must have started living in the UK by the 31st of December 2020 and can stay in the UK for a further 5 years. They can then apply to change this to settled status once they've had 5 years continuous residence. Some EU citizens may be able to stay in the UK without applying, for example, Irish citizens or those with indefinite leave to remain. The deadline for applying for settled status is the 30th of June 2021. Businesses wishing to retain talented EU citizens may wish to help employees to prepare the necessary application. After the transition period, you can still recruit EU citizens, but you'll need to apply for permission and obtain the necessary visas. To recruit workers from outside of the UK in the skilled worker category in future, you'll need to demonstrate that they speak English at the required level, they have a job offer from a Home Office licensed sponsor, the job offer is at the required skill level of RQF3 or above, which is equivalent to A level, and they'll be paid at least £25,600 or the going rate for the job offer, whichever is higher. If the job pays less than £25,600 but no less than £20,480, the applicant may still be able to apply for permission by trading points on specific characteristics against their salary. The new system will not apply to EEA or Swiss citizens already employed in the UK, as they can choose the EU settlement scheme. To become a Home Office licensed sponsor, you must apply online and do the following. Check that your business is eligible. Choose the type of license you wish to apply for, which will depend on what type of work you want to sponsor. Decide who will manage the sponsorship within the business and pay a fee. You'll be given a license rating and be able to issue certificates of sponsorship if you have jobs that are suitable. This will remain valid for 4 years as long as you check that your foreign workers have the necessary skills, qualifications or professional accreditations to do their job and keep copies of documents showing this. You must only assign certificates of sponsorship to workers when the job is suitable and tell the UK Visa and Immigration Service if your sponsored workers are not complying with the conditions of their visa. The visa rules are not straightforward, and it's strongly advised that you seek professional advice. From the 1st of January 2021, there are new rules to travel to the EU or Switzerland, Norway, Iceland or Liechtenstein. Under these new requirements, UK nationals will need a visa if they want to stay in the EU for more than 90 days in a 180-day period. European health insurance cards remain valid until their expiry date, and the plan outlined in the agreement is to replace these with a UK Global Health Insurance Card. A person does not need an international driver's permit to drive in the EU as a UK citizen, as long as they hold a valid UK licence. Should you or any representatives of your business need to travel to the EU in future, you might want to consider the following. Firstly, check your passport, get travel insurance that covers your healthcare, check you have the right driving documents, tell HMRC you're going to be working in the EU, check whether you'll need to pay social security contributions in the country you're working in, check whether you need indemnity insurance for your employees, and check you've got the right documentation to take goods to the EU. UK professional qualifications won't be recognised automatically in the EU, which will make it more difficult to work in the EU, especially for those in the service sector. It appears that UK citizens will need to apply to the individual country in which they wish to get work to get any professional qualifications accepted. This may change as the agreement suggests a framework of mutual qualification recognition in the future. There are measures which commit both the UK and the EU to maintain common standards on workers' rights, as well as many social and environmental regulations. The UK does not have to follow EU law, but they do have to be seen to protect the rules of fair competition. Those looking for work for longer periods in the EU may require authorisation via a work permit for most EU countries if you're a UK citizen. In most cases, you'll also need a job offer from your chosen country so that you can get a visa to move there. Check with the UK-based embassy of the country you want to work in to see what you need to do. As this presentation has hopefully demonstrated, the various rules relating to the new trading relationship with the EU are complex. There are various new requirements that UK and EU businesses need to meet, many of which they need to comply with now or certainly in the very near future. To ensure smooth and continuous trading, businesses should seek the help of experienced professional advisors to ensure they remain compliant and to minimise barriers to suppliers and sales with EU consumers. Our team at Thomas Coombs are standing by to assist businesses with this process and any new developments that may emerge in this new post-Brexit era. If you'd like assistance with any of the issues we have discussed, please speak to us at your earliest opportunity.